Hello everybody, welcome to the true in-depth guide to the economic calendar. As always, I'm not here to waste your time, so we'll go ahead and get straight into it. So this video is going to be broken down into two separate parts. Part one being mainly the fundamental overview, where we talk about how to get the calendar set up and particular news events and things of that nature. If you've been trading for a while, then you probably won't necessarily need to look over this part, but there are a few hidden gems found in this section that you might not know about. This part is mainly geared towards people that are newer to trading, and the second part of the video, which is going to be the technical overview, is where a majority of you will find what you are looking for. But anyways, in the fundamental overview, we're going to discuss how to actually view the calendar, proper calendar settings, as well as understanding news events. So getting started with how to actually view the calendar. First things first is you want to go to a website called forexfactory.com. Now there are a couple other websites you can use to actually view the calendar, but in my personal opinion, I think Forex Factory is the best. So once you go over to forexfactory.com, it will prompt you with a screen that looks like this. And it looks like a lot, I know, but the only important thing you need to look at is this section up here where it says calendar. And you can make an account if you want to. It's not necessary to create an account, but I believe it will save your settings that we're about to put on, and it'll make your life a little bit easier, but it's completely optional whether you wish to create an account or not. So regardless whether or not you choose to create an account, you're going to click on the calendar tab right here. And then once you click on the calendar tab, it should show you the full breakdown of the economic calendar. Now again, I know it looks like a lot, but very few of these actual news events being presented are important. So what you're going to do next is you're going to go to the filter tab right here, click on filter, and then once you have clicked on the filter tab, you're going to copy these settings right here. So you're going to uncheck every box apart from the USD news, and then you're also going to uncheck the orange folder and the yellow folder. And you can pause the video if you need to. But once you have done that, then you're going to click Apply Filter. So these news events that are presented right now, the red folder USD, these are the only ones that are important. So as we can see here, looking at all of the news that we have, we can see Monday has no news whatsoever. Tuesday has a news event called CPI happening at 8:30, and it's also important to change the time on Forex Factory to Eastern Standard Time. That is extremely important as well. Wednesday, no news. Thursday and Friday both have red news folders. So this is how you properly read and view the calendar. Again, a quick summary, you have the specific news events releasing and you know the time they will release at along with the day. So now looking a little bit closer into actually understanding the news events. So to put it in simple terms, a red news folder is simply just a timed volatility injection. So volatility simply adds probability to a trading session. This is why a non-news day is considered low probability. You might hear people say that a non-news day is a low probability, but there is a caveat to it. I get asked all the time, Jacob, when am I allowed to trade a non-news day? Because under specific criteria, a non-news day is still tradable. And that criteria is if it is a continuation of a day that had news. Meaning if Tuesday had news and price expanded and you're expecting Wednesday to continue, but Wednesday does not have news, the day is still tradable due to the fact that it is a continuation and the damage was already done on Tuesday. Now, on the other hand, if it is not a continuation day and you have nothing backing up the trading day with no news, then generally that is where you'll see the consolidative price action take place, being low probability. So looking at an actual chart example, we can see that on the left, this is a trading day with news, and on the right, this is a trading day without news. So we can see the difference in volatility. We can see that on the right, it was very back and forth, not necessarily clean price action. But on the left, we can see that price action was a lot smoother. So we created one run down and then created a straight shot higher, offering cleaner price action. All right, so now getting into the significance of red news folders. So individual news folders have specific tiers to them in the sense of time. So 8:30 a.m. news typically is the best in terms of volatility and offering clean price action. 9:45 a.m. is decent. You'll primarily see your flash PMIs or your standard PMIs at 9:45. And then at 10 a.m., that is typically the worst news events to try to gauge. You'll find consumer confidence, JOLTS job openings, things of that nature at 10 a.m. And usually price action isn't the best, even if this news folder is presented. And finally, we have unique, which is typically unpredictable. So, for example, if the Federal Reserve Chairman speaks at a random time of the day, or the president speaks at a random time of the day, typically these events are unpredictable. It's hard to decipher whether or not volatility will come in, because if you've been trading this year, then you know if Trump comes up and says the wrong thing, then you know the markets can whipsaw in any direction. So it's always best to just completely discredit these news events. Don't really include them in any analysis. And if they're presented in the morning session, take that morning session with caution. All right, so the big three. There are three big news events that usually have lasting effects on the market. These news events include CPI, non-farm payroll, and FOMC. If a particular market is ever decoupled, typically these news drivers will synchronize everything. Meaning, let's say you are comparing the S&P 500 to the Dow in terms of a cracking correlation. Typically these news events allow everything to come back in sync if they are decoupled. And the same thing goes for example, the US dollar versus the euro, or the euro versus the pound. If you're ever comparing a particular market and it is decoupled, wait for these news events to come in and make everything clear. But now looking particularly inside of non-farm payroll. So non-farm payroll is always the first Friday of every month. And if the previous trading days before the event have expanded far away from the weekly opening price, non-farm payroll has a tendency to return into the weekly range. So looking at a chart example here, we can see Friday comes about, the first Friday of February. Price trades above Thursday's high right here. The news event releases, and then shortly following, the rest of the day is spent returning into the weekly range that had been presented. So before Friday, the entire week was primarily bullish, trending higher. Non-farm payroll Friday came about, the news event released, and then shortly following, a return into the range was created. And now looking at CPI. So CPI falls on the second full week of the month. CPI does not have to follow a standard day like non-farm payroll. For example, non-farm payroll always falls on a Friday. But CPI generally will be between Tuesday, Wednesday, or Thursday on the second full week of the month. So CPI typically expands and continues in the same direction of a cracking correlation formed the day or days before the news event. If we look at the chart comparing the S&P 500 and the NASDAQ, we can see that there was an SMT divergence before the news event. This little red sticker right here on this candle, this is the delivery of CPI. So as we can see, the S&P 500 takes out this high, whilst the NASDAQ creates a failure swing on this high, creating a crack in correlation. And then once CPI releases, that is whenever it distributes, following in the direction of the crack in correlation. So finally, we have FOMC. FOMC can have lasting effects on the markets depending on if the interest rate changes. So FOMC is more so a fundamental news event, meaning the actual numbers that go into the release do have an effect on the real world. And depending on how this number changes, that could have very long-lasting effects on the markets, and you could see moves that trend for sometimes even months at a time. So it's always important to keep note on the actual interest rate number to aid in your analysis. But if the interest rates lay flat, typically it doesn't cause much traction in the markets. And FOMC usually holds the same characteristic of CPI in terms of anticipated expansion. So now we're going to go ahead and get into the technical overview. So in this portion, you will understand how to apply the economic calendar week by week, time aligning to price. I know we hear everybody say, once time is right, price will align. But in this lecture, you will finally understand what that means, and also the real function of red news folders. So starting off with applying the economic calendar, days with red news folders often serve as pivot points for the week. Understanding this can tell you when the high or low of a week is likely to be in and is useful for gauging directional bias. Combining all of this together allows you to create your own weekly profile / roadmap. So looking at an example here of the economic calendar, we can see that Monday, Tuesday, and Wednesday don't really hold anything of substance. Remember, whenever we have those news events outside of the standard times that we look for, typically we ignore those. So Monday, Tuesday, and Wednesday doesn't hold much significance. Thursday and Friday, having both 8:30 a.m. news drivers, we can likely expect something of substance to be there. So we can say Thursday or Friday is likely to form the high or low of the week, and especially Thursday being the first day of the week with a true red news folder is likely to be more volatile or introduce volatility into the week. So looking at the chart, we can see that from Monday all the way till Wednesday, price was just consolidative. But once Thursday came about, specifically at 8:30 or within that 8 o'clock 1 hour candle, that is when the expansion of the week took place. And we can see price falling lower and lower, continuing that expansion. And then Friday came about, released the news, and price continued even lower. So the main focus would have been skipping the beginning portion of the week and then trying to figure out a way to encapsulate Thursday and to get alongside the run once volatility has truly entered the market. And as we can see, Friday made the low of the week. But again, keep note of, until we had that news event, specifically on Thursday, the first real news event of the week, price action was just consolidative, lackluster, not too much going on. But as soon as we got that volatility injection, that's when the true run of the week took place. And now looking at time aligning to price. So again, everybody always says this, but what does this actually mean? Well, whenever you have news plus a price signature, that equates to an expansion. So time being news, you know the specific time volatility is coming into the market. And price signature is just price. Once you have the blend of time and price, that is whenever you get the expansions that you are looking for. So Jacob, what is a price signature? The simplest way I can put it is just a crack in correlation. So if you have news release on a particular day, and then at the same time news releases, you have a crack in correlation, typically that is what creates your expansions. That is time aligning to price. You can't have one without the other. You can have a crack in correlation without news, but it'll be low probability. You can have news without a crack in correlation, but it'll be unpredictable. Once you blend the two together, that is whenever you get the magic you are looking for. And to add on to that, we have the secret function of news. So whenever you have a news release, if you have a crack in correlation form before a news driver, then the news driver will typically pose as distribution. So crack in correlation before news equates to news will likely distribute. This is more so a rare instance. This doesn't happen as much as what we're about to look at, but this still is a possibility. If you have a clear-cut crack in correlation before news, then news typically poses as distribution. And again, you'll commonly see this with CPI and FOMC. But on the other hand, if you have a crack in correlation after news, then that poses as manipulation. So if you don't have a crack in correlation before news, news will likely manipulate and create a crack in correlation, giving price a reason to expand. So it's all if then. Typically, you'll see news release and then a crack in correlation take place, which serves as manipulation, and then shortly after, you'll see distribution. But sometimes you'll see news serve as distribution, especially on the higher time frame news events. But as a gem, typically you'll find the news serving as manipulation on standard 8:30 news events, meaning things excluding the big three. So standard, unemployment claims, core PCE, etc., things that are basic. Those will cause the manipulation. So hopefully you all found this one insightful. If you did, make sure you leave a like and subscribe, and also join the free Telegram for more content just like this, as well as you'll also get notified ahead of time if anything ever gets released. So with that being said, good luck and good trading.